I'd like to thank everybody for joining me today. Today, I want to talk about charitable planning. As we get closer to year end, this is one of the tax planning strategies that really becomes very important and really is a win-win strategy for a lot of our clients. When you think about charitable planning, what I like to look at is, who's charitable planning for? Of course, this is for clients that are charitably inclined, that they give to their church, their community, organizations that they're involved with, but they want to do more. This is a good opportunity to be able to do more. But I also look at, it's clients that just want to reduce their income taxes or clients that want to reduce their estate taxes. All of these are good fits for charitable planning and the charitable planning strategies. When you think about charitable planning, part of it is when do you want to give to charity? When can you give to charity? So you can do it now. And if you think about now, it's, do you want a tax deduction now? Do you want to benefit that charity? If you're working with the Salvation Army and you want to see the good that it's doing today, well, you can give them money today, you can give them property today and get that tax write-off. Or you can do something where you're going to give it in the future. Now you can say, make a commitment, I'm going to give X property or X money to charity in the future, and you can let the charity know. Or you can set up a charitable remainder trust or a pension or a foundation, something like that, and you're going to give that into the, to the charity in the future. You might get some tax benefits now if it's structured out right. Finally, you can set it up to give to charity at your passing. So as part of your will or trust, just part of your legacy planning, you want to give something to charity, a percentage, a dollar amount, whatever it is, you can set that into your estate planning documents so that when you pass, that money goes off to charity, and you'll get a charitable deduction in your estate tax return if that's something that you need. So the timing is totally up to you, whether it's now, in the future, at death. All of those are good options. They're, again, depending on what you're trying to accomplish and what your goals are. There's a lot of ways to gift, and it can be as simple as an outright gift. You just open up the checkbook and you write a check and give it to your favorite charity, and you will get a dollar for a dollar deduction on your tax return, itemized deduction, Schedule A's, where it's going to end up on your 1040 return. Outright gifts are a great way to give money. Another way is a donor advised fund. With a donor advised fund, basically you can go and you can set up an account through a brokerage account, your bank. The donor advised fund is a place that if you're not quite sure who you want the ultimate charity to be, but you want a tax deduction. So you could write a $100,000 check to the donor advised fund, move that money over. You'll get a $100,000 tax deduction this year on your tax return. And the donor advised fund, over time, you can start giving that out to a 501c3 charity anytime you want. There's no limitations saying you have to give it out this year or a certain percentage this year, but it will have to go to a 501c3 entity. Just gives you time to decide who you want that to go to. Charitable lead trusts are a great way to provide tax deductions now, give money to a charity, and you can set it up in a charitable lead trust and say, I'm going to put $1 million in the charitable lead trust. For the next 10 years, the 5% of that trust will be distributed to your favorite charity, whoever that is, and you can change that. So think about that. $1 million goes in. You're going to be giving $50,000 a year to charity for the next 10 years. At the end of 10 years, whatever's left in the charitable trust distributes back to you or your family, and you get a charitable deduction now for that present value of the stream of payments you're going to give to the charity over the next 10 years. So this is a great way to give to charity now, be able to see the good that you're doing, And if you think about it, at the end of that 10-year period, 5-year period, whatever it is, that money's going to come back to you. In a lot of cases now, that money can be used for your retirement, move on to your heirs, however you want it to be set up. Kind of a flip side to that is a charitable remainder trust. A charitable remainder trust is a great way to sell property or appreciated assets income tax free. So think about this. If you've got an apartment complex and you're just at that point in time where you're sick of fixing toilets and you want to sell it, but you don't want to pay the taxes on the sale. And I see this a lot, it may have $1 million fair market value, but it only has a tax basis of maybe $200,000. So you would have an $800,000 taxable gain. Well, we can move that property in, set up the charitable remainder trust, put the property inside, and now we'll get a tax deduction when we move the property into the trust. The trust can sell that apartment complex in this example and not pay any tax on the sale of that property. That $1 million can now be reinvested into stocks, bonds, annuities, whatever you want. Now, for the rest of your life, or if you're married, your joint lives, or a set period of time, during that time period, the trust is going to distribute back to you a stream of payments. And now when you set up the trust, you'll say, I want this to be 5% or 6% or 7%, whatever that amount is. And it will pay that out to you every year. Most likely that payment's going to be taxable, but that gives you, if you think about it, retirement income, if that's what you need. And then at the end of the trust term, if it's joint lives, at the end of both of your lives, then whatever's left in the trust is distributed to the charity or charities that you name. Finally, as a private foundation, you can set up a private foundation to where you can put, let's just say, $1 million in, get a tax deduction for moving that money in. Now that private foundation is going to distribute money over time to the charities that you want to benefit. Now, from the foundation, you can invest in there. Your family can be the operating board there, but it just gives you the ability to do more over time. Now, with charitable planning, what I look at is we've removed assets from the estate. And a lot of times, I look at this and parents, they want to benefit the charity, they want to reduce taxes, they want to do all of these things, but they want to pass on their legacy to their heirs, to their children, their grandchildren, whoever it is. And if you think about that, well, if I pulled $1 million out of the estate, what if I use life insurance and create a life insurance trust? And with that life insurance, now I can replace to my heirs the gift that I made to charity. So the nice part of this is, if I gave $1 million to charity, now I've given $1 million, I get a life insurance policy for $1 million to pay back to my kids or grandkids. Now the heirs can receive that payment, income and estate tax free. So it can really create an opportunity where you really create a win-win-win charitable planning strategy. The charity that you're benefiting appreciates all that you're doing. And we've done the charitable giving to the people we want to. You've created income and estate tax savings right now that you can write off against your taxes, so that you're eliminating taxes now while you're repositioning assets. And you've used the life insurance to replace that legacy that you want to pass on to your heirs. So if you think about this, win-win-win charitable strategy, all using taxpayer dollars that we can deduct, that we can use, and it's a great strategy for you, your charity, and your family to win. I appreciate everybody getting on. If you have questions, feel free to reach out. If not, we'll talk again next week. Thank you.